The White Tiger Knight YouTube channel. Buying Puts, Part 1.
Alright, the White Tiger Knight coming at you with a video on put options. I'll keep the the gun videos coming for all you gun fans pretty soon, but I just want to change pace here and start talking about the put options. So this is the White Tiger Knight channel, and this is the put. Now, if you're not familiar with this type of graph, go ahead and check out another one of my videos. I explain it a little better, but just for quickness, this x-axis here is the stock price, and this y-axis is your profit and loss. So as you can see, from 0 to 10, the stock price is at 10 right now. If it goes to 11, it will move this way. If it falls, it will move this way. And then this is the put right here, this little graph right there, and that determines where your profit is and where your loss is. So as you can see quickly, if the stock price actually rises with the puts, you're actually going to lose your premium here. But if the stock price falls a significant amount, you will start gaining in profit. So the puts are a good way, a good alternative for shorting a stock with a low risk, because the only thing you risk is the premium. Okay, so in this hypothetical example, the stock price is $10, the strike price for the puts are $10, the premium is $2, and the expiration is 1 month. Okay, so that's what this graph represents. It shows automatically here the $2 premium, and then if the stock price starts falling, say to $9, you'll start gaining, and say right here about $8 will be your break-even point. $2 for the premium, and then anything below that you'll be in the profit. It's important to note that the longer the expiry is away, the higher the premium, and you actually risk the time decay, because as this moves closer to expiration, this premium will start shrinking, because again, you pay for the amount of time to have this right. Okay, now in this example you can see pretty quickly you have a $2 max loss, which per contract you have 100 shares per contract, so that's $200 per contract maximum loss. Okay, here for example, say you decided you want to buy 10 contracts. This is an important note. You want to buy 10 contracts at $2. Okay, the contract is represented by 100 shares, so that's $200 per contract times the 10 contracts. Okay, you'll have about 1,000 shares. Okay, with 10 contracts, $100 shares per contract, that gives you 1,000 shares times the $10 price will give you $10,000 in equity. So you would need $10,000 left over in equity to actually execute this put, or you could just sell the put back, and that's what I talk about here, because the premium for the put could go higher and the profit can rise above this kind of just straightforward numbers here, because the premium value can rise at an exponential rate faster than even the stock price falls, potentially. But just for here, so exercise equity, say again, for example, you buy the puts at 10, it falls here, at 3, okay? Actually, in this case, you would only need to buy the stock at 3, and then you could go ahead and use the put to sell it at 10. So your exercise equity might be a little different in this, so you can go ahead and scratch that. That's mainly for call options, but just to let you know, again, I'll just go back through the scenario. You buy it at 10, it falls, say, to 5 even. You go ahead and buy it at 5, sell it at 10. Okay, you have to subtract the premium you paid, and you get a profit of 3. If it goes all the way down to 1, you can have a profit potential of 7. This is a good one right here. At $3, the stock owner loses $7,000 in the trade if they bought it at 10. The put owner would gain $5,000. See, at $3 plus 5. Okay, this is at the 10 shares or 10 contracts. And the short seller, it's important to note, would actually gain $7,000. So they would be the best off in this scenario, but their risk is highest because their risk is exponential. As the stock price keeps rising, the short seller can keep losing money, but the put owner can only lose the premium. So if the stock goes up, it's important to note here, if the stock price hits $6, the profit is $2,000. for the put owner. If the price hits $3, the profit is $5,000 for the put owner. But if the price turns around and goes way up and hits $20, you only lose $2,000. Whereas if you were short in that stock, you would have lost a lot more than that. So, so that's just an important note. It's a good way. Buying puts is a good way to short stocks with limited risk. And hopefully that came across pretty well. So again, this is the White Tiger Knight channel, signing out. One more thing here on the exercise equity. I apologize for messing that up before, but I just want to go ahead and clarify that now without having to make a whole new video. So basically, this whole exercise equity would be if the share price was at $10. So when you want to exercise these puts, the share price will obviously be below $10. Most if you're in the profit. So let's just say, for example, I'll give a hypothetical scenario of this exercise equity concept. So you buy the puts at $10. Okay, let's just say for conversation's sake that that the stock price just tanks. It takes a super dive and it's trading at $3 right now. So you have 10 contracts of the stock X, let's just say, to sell this stock. Again, now puts give you the right to sell at $10. So you have these 10 contracts for the $10 strike price, but the stock is trading at $3. It's important to note, though, that your contracts represent about 1,000 shares. So in order to exercise your puts and utilize the the maximum potential there, you would have to buy 1,000 shares of the stock at $3, which in this example would only be $3,000. Now that's a moving target based on where the share price is. If it was at 4, it'd be 4,000, 5,000, so on and so forth. But your exercise equity in this position would actually at this point only really be $3,000, because again you're buying 1,000 shares because you have 10 contracts times 100 shares. Okay. And that's $3,000. So you would pay $3,000 to buy the stock, you'd exercise your puts for whatever the commission on that is, and you would go ahead and turn around and sell it for $10. Okay? It's pretty good. I mean, you subtract the premium that you paid, and you get your net profit. So, as you can see here, if the price hits $3, your net profit would be $5,000, because you would actually get $7,000 coming in, but you would in this case pay $2,000 for the premium. So your net profit would be $5,000, and your exercise equity at that point would actually only be $3,000. So I just had to clarify that for you guys, and that's the White Tiger Knight signing out.